We love talking three stocks here on Ausbiz. This one has a technical twist, and the man with the charts is Jason McIntosh from Motion Trader. Good morning, Jason. We've had lots of volatility in the markets. That must be a charter stream.
Yeah, hasn't it been an interesting few weeks, Annette? It's yeah, look, it's good to see the market bouncing a bit today, but I think there's still some vulnerabilities there, and below the 100-day moving average still, and the US didn't close particularly strong last night. So, look, maybe this this pullback has some legs in it still.
Well, we know there's plenty of cash. Let's have a look, because you've given us three stocks. I had a look at them myself, but we're here to talk to you, not me. Vista Group, what's going on there?
Yeah, Vista Group's a really interesting company. It's one of those stocks probably a lot of people don't know very much about. It's got a market cap of about $600 million, and it's not in the All Ordinaries. So, look, as soon as a stock's not in the All Ordinaries, it just naturally becomes harder for people to find and really be aware of. But while it's probably not top of mind for a lot of people, chances are they've had some exposure to its products simply by going to the movies. So what Vista does is they provide software and technology to the global cinema industry. And they've got this cinema management software. They've got about 38% market share across the globe. And if you exclude China, it's a 51% market share. And this is for the bigger cinemas where there's like 20 plus screens. And look, of course, COVID's been a disaster for the cinema industry generally. So if the movies weren't closed, they were operating at partial capacity, and then where are the blockbusters? There hasn't been a blockbuster for 18 months, and this is, of course, makes it people less likely to go along even if the cinemas opened. So look, and all this is translated into their results. So their last yearly result was look, I think it was revenue was down 60-odd%, and they had a $50-odd million loss. So pretty ordinary time, but I think there's a real turnaround which is starting to take shape in their current results. So their last quarterly update was really encouraging. June quarter revenue was flat, which is probably to be expected, but the positive part was that their recurring revenues are up 13% in a difficult environment. So that suggests they're maintaining customers and they're bringing on new customers as well as upselling products. And then you've got their EBITDA, and they had a $13 million swing in a positive sense there. So they went from a loss to a profit of $6.5 million. So look, all up, management has done a good job of keeping expenses down, and they've got a strong balance sheet of something like $58 million in cash. So they're well placed to continue to ride this out whilst we do wait for a decent full-on recovery to kick in. And management thinks that recovery is pretty nearby, and you just have to look at the release schedule for movies over the next 18 months, and you start seeing all those blockbusters coming back online, and that's really, I think, going to help fuel the resurgence in the cinema industry. And like the latest James Bond, it's out tonight in the UK. The premiere was last night. It's out in the US, and that next week, and that just continues on over the next 18 months. And look, the company's saying as long as about 80% of cinemas remain open in their key markets, that they're expecting revenue for next financial year of about 100 million, up from 88 last year. And it's also worth noting that this company was on a real growth footing prior to COVID. So they increased revenues every year from 2015 through to 19. And, if we just get back to some sort of resemblance of the way things used to be, and we get back to those cinemas, I think this is a real good growth and recovery story to play out over maybe the next year or two. And on the charts, we're starting to see that momentum come through from a low base. So really interesting stock to keep an eye on. As
well as someone's certain pink jacket on the red carpet. And let's switch to Family Zone Cyber Security. Now, I've certainly never heard of that one, so enlighten us, Jason.
Yeah, and that's the thing with some of these stocks. One of my favourite parts of scanning the market for momentum is that I often find these companies which I've never heard of either. And look, there's 2,000 odd stocks out there. So once you get outside the ASX 200 or maybe 300, they start to become quite unfamiliar. But look, this is very much a case in point. So they've got a market cap of about $550 million. And it hasn't made its way into the All Ordinaries yet. It's probably not too far off. And what they do, it's a tech company, and their software basically keeps kids safe when they're online. And it's all about it operates from an app on a parent's smartphone. But the most interesting part of the business, I think, is what they're doing with schools. So their school-based focus is where I think the real potential lies. They've got something like 18,000 schools around the world using their software, and it's a segment that's really growing quickly. So just in the last quarter, in the June quarter, they had record revenue growth, and their average recurring revenue is up something like 95% year on year. They've got their student licenses jumped 164%, and their school licenses 127%. So a lot of growth coming through, and a lot of that's coming from the US. So they added over 1 million students and over 2,000 schools in the last quarter. And what that equates to, when you look at the whole US school environment, they're in around 5% of US schools, and that's up from 2% a year ago. And there's record funding going into the education system in the US. So the company believes that that's really going to help, grow and roll out their product in that big market. So a lot of growth potential there. Another interesting thing that's happened recently is they made an acquisition in the UK, and it's they bought the UK's leading provider for kindergarten to year 12 digital safety for kids. Cost them $142 million, so a big purchase relative to the size of the company, but it gives them a 38% market share of that UK market. And they also expect they're going to get really good synergies from combining the products from the acquisition with their own suite of products. So it's, look, there's a really, really good growth story there. They're not profitable as yet, but the growth potential is there to make this look a really valuable company into the future if they can continue to convert on what they've been doing so well, up to date. And just lastly on this, another positive is that management has a strong stake in the company, and this is one of the things I look for in these more emerging type plays. You want to see management not only having a vision but being on board the vision themselves with their own money, and that's the case with Family Zone. So again, one of those stocks which during this market pullback possibly provides an opportunity to sort of have a look at it and prepare to maybe take a position if this sort of thing interests you over the next maybe year or two.
Now, Jason, we're bumping up against the clock, so we need a super short steel update with Bisalloy. Rapid
fire on this one. Okay. Well, this is a classic value play. A lot of things I find are growth orientated. This is all value. They're Australia's only manufacturer of high strength structural steel. So it's used in the defence industry as armour. So the current submarine fleet actually use their Bisalloy Steel as the armour plating. Also used in construction and mining and other applications. It's a high quality product. They export it around the world. They've got a good distribution network in Asia and the United Arab Emirates. And fundamentals look great on this one. So operating EBITDA for the full year was up 25%, net profit after tax up 31%. And what's interesting is when you look back over the last few years, they've been increasing EBITDA each year since 2016, and they've also had double-digit return on equity since 2018. So I think a very well-run company. Management think they've got more EBITDA increases next year, depending on like how things go with COVID, and they've got a history of delivering. And look, all up, I think this is a classic value play. PE of around 8, fully franked dividend of around 5.6. So look, growth potential to boot. So if value plays and these lower price stocks are your like market cap for about $71 million. So it's not the most liquid of stocks, but a very interesting one nonetheless. So I think good upside potential maybe over the next year or two.
Oh, Jason, we love names that we haven't heard. You certainly had me Googling, and it's always a pleasure. Thanks so much. See you again.